Welcome to Talk Tickers. Today, we're breaking down Zenvia's Q2 2025 earnings call, and boy, was it a puzzle. How could a company blow past revenue estimates only to have its stock get absolutely crushed? Let's dig in. So let's start with the market's verdict, which was, to put it mildly, brutal. The stock completely collapsed, dropping over 25% the day after the company reported their results. And this brings us to the million-dollar question for any investor looking at this. How on earth does strong top-line growth lead to such a brutal, punishing sell-off? Well, we're going to unpack that right now. Okay, first things first. Let's look at the headline numbers, because this is exactly where that strange disconnect between growth and investor panic started. And this slide right here, it just illustrates the core conflict perfectly. On the one hand, you've got revenue soaring, up almost 24%. Awesome, right? But then you look at the other side. Gross margin, it just fell off a cliff. We're talking a drop of over 1,800 basis points. That's a full 18 percentage points gone, bringing the margin down to just 19.7%. And that kind of margin compression just absolutely decimated profitability. Adjusted EBITDA was down a staggering 68%. Their net loss got even wider. And critically, the company burned through 25 million reais in cash from its operations this quarter alone. Ouch. So to really get what's happening here, you have to understand that Zenvia is really two completely different businesses operating under one roof. And right now, they are moving in totally opposite directions. Now, what's really fascinating about this slide is it lays the whole problem bare. Their low-margin business, the CPaaS segment, grew by a whopping 33%. But, and this is a huge but, its gross margin just collapsed to a tiny 11.8%. So this high-volume, low-quality revenue has ballooned to 72% of the total business, and it's basically cannibalizing their stable, high-margin SaaS business. To their credit, management was pretty upfront about this. On the earnings call, the CFO, Shai Shore, pointed directly to an extremely competitive market and rising carrier costs as the reasons for that margin collapse in their CPaaS business. All right, so how does management plan to right the ship? Well, they didn't just admire the problem. They laid out a pretty clear three-part strategy to try and fix it. So here's the game plan. Number 1, grow the high-margin SaaS platform, the Zenvia Customer Cloud. Number 2, stop the bleeding in the CPaaS margins and get them stabilized. And number 3, execute on some serious cost cuts to the tune of 30 to 35 million reais. And here's an important point. Despite all the chaos coming from that CPaaS segment, management stood firm on their full-year guidance for their core high-value SaaS product, ZCC. That was a clear signal of confidence that they still believe in their best business. But even with a clear plan and confident guidance for their core product, the market just wasn't buying it. And the reason? Well, it boils down to one critical and, frankly, pretty alarming number. Zenvia ended the quarter with just 32.6 million reais in cash on its balance sheet. That's it. Now remember, they burned through 25 million reais this quarter alone. So you've got 32 million in the bank. You do the math. The market immediately started asking a terrifying question. How long until the money runs out? So essentially what happened is investors heard the turnaround plan, but they placed a bet against the timeline. The big fear is that the company's cash position is going to become critical before the benefits from the cost cuts and margin recovery have time to actually work. It's a race against the clock. So where does that leave the stock heading into the Q3 report? Look, the narrative is definitely challenged, but you could also argue that the bar has been set incredibly low. As we head into the next call, there are 4 key things we'll be watching. Number 1, any sign of that CPaaS margin starting to recover. Number 2, and this is the most important one, a huge reduction in their quarterly cash burn. That is absolutely non-negotiable. 3, we need proof that their high-margin ZSCG growth is picking up steam. And finally, any news on asset sales to get more cash in the door would be a big help. Until we see tangible evidence that the cash burn is under control and the quality of their revenue mix is actually improving, our rating has to remain underperform. The operational story has potential, for sure, but the balance sheet risk just overshadows everything else right now. And now for our trade idea. With expectations this low, any piece of good news on cash flow could cause a massive relief rally. But here's another way to think about it. You could watch for any strength in the stock before the next earnings report. If the company then fails to deliver on improving that cash flow, that pre-earnings pop could suddenly become a very, very compelling short opportunity.
And as always, this analysis is for informational purposes only. This is not financial advice.